I was talking to you, Michelle, about the claims number. You don't think that necessarily matters. It was, it dropped 40, it's up 50. But
exactly.
Government shutdown effect on anything we see today? Let's get that out.
I mean, it's going to create the uncertainty that it will. If we get any kind of a surprise, it shouldn't have an impact on the employment statistics from the payroll, on the payroll side. However, and we've got a relatively low number. Our forecast is for 135. It isn't about the government shutdown. I think it's more about some payback from an unusually exceptionally strong December number.
Yeah.
But the bottom line is between the potential for payback and the uncertainty about a shutdown, it's just and new seasonal adjustment factors and the incorporation of what were very small annual revisions. It's going to be I think it's going to be very noisy and it'll be hard to tweeze out. But the shutdown itself, it shouldn't have a direct impact, and it looks like from the fact the claims numbers in general stayed relatively low through the shutdown, that the secondary impact isn't, or indirect impact from the shutdown also was pretty minimal.
The Fed that suddenly found religion in terms of the possibility that the economy is, I don't know, fragile or whatever caused them to get more dovish. That 300,000 number, was that an outlier? Are we ready to get a 110 or a 90 or something like that?
Well, I mean, again,
ADP was what, 2?
It was, but if you looked at the average over the 2 months, a little over 200,000. Again, a number like we have at 135 plus the 312, the average of the 2 months, again, somewhat over 200,000. It's kind of consistent with what we've seen in terms of ADP. So it was an unbelievably December report, exceptionally strong. I mean, every aspect of the report was really solid. And we know how these data go. They kind of ebb and flow. I just think that we shouldn't overreact to anything that we see. Fundamentally, despite all the pessimism that kind of swept through the markets about the turn of the year, the data, for the most part, that we've seen continue to suggest that the economy is expanding at a relatively healthy pace.
So I agree with Michelle. You got to know where to look in this month's payroll report. But what I would also say is, as much as we want to be focused on the exact number, the Fed this week has changed the calculus for how the market is going to assess this number. And we are actually in a bit of a back to the Goldilocks scenario, because if it is a weak number, as Michelle is forecasting, then the market is going to say, great, we've got the Fed's support. That's why they've paused. And if the number is exceptionally strong, then the market is going to say, great, we have an economy that's picking up.
I almost feel like the market wants better numbers at this point, because the Fed's going to be on hold no matter what for the next several months.
Yeah.
So I feel like you'd be rooting for those stronger numbers in the market just because you're more likely to.
Yeah, I think you're always looking for stronger numbers. But what I would also say is, if I look at earnings, and if I look at earnings revisions, the extent to which they have been revised down is really tremendous. And the number of up to down earnings revisions ratio, that ratio is now negative to the same extent as we've seen in some prior instances in which the markets were actually able to inflect higher. So I think what I'm saying is the slowdown that we have forecasted in December is now, maybe not almost fully, but is certainly being reflected in those earnings numbers. And that's one of the reasons why, even if it's a weaker number, I think the market could still be okay with it.
So what is your number today?
The 135 with the, kind of benign earnings numbers. And again, I don't want to make that seem like we're in any way sort of negative. I think if you look at the trend over the last couple of months, it would still be quite a healthy, report. And I agree with what you said, Becky. I mean, I think to some extent the Fed has removed itself from the equation. It's signaled that it's going to wait longer to see how economic conditions evolve. So I think there's a good thing to say that the markets can feel comfortable. I think the other important with growth, and I think the other important thing I feel is that the Fed has made it clear that inflation is going to be really important. I think now that they're at neutral, as long as inflation stays, it does not look problematic, stays in line with the target, they can actually themselves root for growth, and like they always do, and allow the economy to grow. Very similar to what Powell had talked about Greenspan did in the late 1990s. He held the committee off. Let's wait and see. If inflation rises, we'll act. But until then, we're going to take it meeting by meeting, and then they ended up, of course, holding off and not raising interest rates for, that was it, until they actually had to cut during the
I'm sorry, I was looking. You have a number? What's most likely? Will we do 200, less, what, more?
170. 170 is the number that we're looking for. So, kind of right in line with consensus that, if we get somewhere close to that number, then the 3-month average is going to be about 216,000. It's going to be in line with 6 months average and a little bit higher than the 12-month average. So I think despite the noise that we might see in the numbers, the solid pace of job creation should still be there.
3%. We have a kind of tick. No,
scary,
I mean, we had a scary number, if you will. But again, we shouldn't be scared about workers being a little bit more. I won't let you. I don't let you go there. But
supposed to work.
Year over year.
It's the way it's supposed to work.